Hello and good afternoon again, everyone. My name is Sonja van Rensen. I'm an energy and climate journalist in Brussels, and here today as editor-in-chief of Energy Monitor. We're a data-led digital publication that was launched by the New States Media Group in the UK, today part of Global Data, just over 2 years ago, and we write about the global energy transition. We're also a media partner for today's event, which I'm very happy about. And we come together today to talk about a new financial product, an EU Renovation Loan. So for me, I guess I've done a little bit of reading around this now, and we've got an article up on Energy Monitor about it today. The gist of it is that if the EU wants to meet its net zero emission goals and it wants to provide secure and affordable energy to buildings, it basically, well, in general, it basically needs to invest an enormous amount in renovating its building stock. The kind of figures we're talking about are an investment of 1 trillion euros, at least a doubling of the current renovation rate, which is just 1% a year, and an increase in the rate of deep renovations by a factor of 10. So what all this requires is a lot of money, and to put it more precisely, homeowners basically need easy access to low-cost, long-term financing for deep renovations. The EU Renovation Loan is an idea, a concept, a tool that we're going to hear about today, which could help solve this problem. So we're going to hear what it is. We're also going to hear from EU policymakers, buildings experts, and members of the finance community to see what they think of it, what benefits it could bring, and potentially what risks there are as well. In terms of housekeeping, not much to say other than this webinar is being recorded. It'll be uploaded to Climate Strategy's YouTube channel about a week from now. We will have time for questions towards the end, so please send those in via the question tab. And alternatively the chat, but I think the question tab is the one we'll mainly keep an eye on. And I suspect this may happen automatically, but keep your cameras and mics off unless you're actually speaking. And with that, I think I would like to introduce our first speaker today, who is Claude Turmes, Minister for Energy and Minister for Spatial Planning in Luxembourg. He was a long-time member of the European Parliament, and I imagine familiar to many of you in that capacity. He was also rapporteur for the Energy Efficiency Directive back in 2012, and amongst the many other things he did, he wrote a book called The Energy Transformation and Opportunity for Europe, which I've got a copy of here, detailing the long history of energy transition policy making in Brussels the last 15 years until today. So over to Claude.
Good afternoon. Thank you, Sonja, for your kind introduction. Thank you also, Peter Sweatman, for all the work he has done around this idea on how can we standardize finances and how can we find a solution to financing renovation. Our dependency on Putin, our dependency on fossil fuels is largely a dependency which is due to the inefficiency in our building stock. So renovating the building stock in Europe is very, very important to diminish our dependency. Today it's Russia, tomorrow it can be some other autocrat. So let's be serious. Europe's we have very little fossil fuel, so we will always be dependent. So we have all of us an interest to go down with the need to use fossils and therefore renovation of buildings, and then of course moving out of gas and fuel over to heat pumps. That is really important for that. It is important for climate. So I think after this summer, everybody should understand that that climate change is now. We have a very small window of opportunity of some years, so we have to now really kickstart massive renovation and not just some pilots. And then, of course, it is also an issue about energy poverty for part of our population. So having efficient housing is, of course, lowering the bills every month, and that is getting people with low outcome out of that energy poverty. So on the new build, just to give you the example of Luxembourg, Luxembourg will be the first country in EU to have non-fossil new building standard from 1st of January 23 on. So that's in some weeks. We have well prepared it with the whole sector. We have an IT system behind to do all the calculations. So our new building stock will be completely fossil free. But the policy where also in Luxembourg I have difficulties to be at the level of ambition where we need is renovation. And I think the most important thing is we have to standardize things, because otherwise we will never get to numbers. And standardization must happen on the way we do consultation. So we spend a lot of time to get good IT sites, to get good people on the ground, to help people to understand the complexity of a renovation, to get the priority right. The second thing is, of course, the whole skill training of the sector, who has to do it, and then also having not 10 different craftsmen coming, but at least one company who can do the coordination, and we need standardization on that. And the third issue where we need standardization is financing. Today it's too burdensome to get to the finance. And on financing renovation, I think there is two tipping points. One is you are young or relatively young. You want to create a family. You need a nest, and then you will buy a house. Very expensive in Luxembourg, horribly expensive, and you will have very, very little money left to do the renovation. So that is where Peter Sweatman's idea can help, because that is where it could bring a top up for these young people this young generation wants to be climate friendly, but they don't have the money in the moment they need it. So that is where it helps. And the second tipping point is normally when we retire from an active working career, we will then prepare our house for the last hopefully 10, 15, 20, 25 or 30 years, where we will be in that house. We will fit it for being less mobile. So all these kind of other gadgets we need to get in to be comfortable. But a share of our population retires without having a lot of money on the shelf. And that is also the second part of our population which needs this kind of instrument which Peter Sweatman has designed. So in that respect, now, so I hope that you understand we need this instrument. And the good thing is that we have trialogues now on the new, on the revision of the existing building legislation, the EPBD. In council, we have last week on Tuesday, we have come to a common position. So the negotiations will be opening maybe already during Czech, but probably they will be terminated under the Swedish presidency. In the parliament, we have a good team, also with Sean Kelly, who will speak later today. So we need, I think, in this trialogue, in this revised EPBD, we need to get this idea of an EU renovation loan in, because if we get this in, we have a solution for getting the money to the young people who want to create a nest, and to the retired people who want to prepare their home for their last decades. So that's my message to you. Thank you very much, Peter, for all the work. Let's continue also beyond this seminar, and sorry for not having been with you physically. Have a nice day. Bye-bye.
And a big thank you to Claude for that. So we move then from Claude, from Luxembourg, and in a way the European Council, to the European Commission. And next I'd like to welcome Robert Nuig, Deputy Head of Unit for Energy Efficiency and Financing at DG Energy. Someone who has also been involved with the implementation of the Energy Performance of Buildings directive in the past, as well as energy efficiency product policy, and earlier on in the Commission worked on environment and health and consumer. So eminently equipped, I would say, to give us a view from your perspective on the importance of deep renovations of the EU housing stock, and how we're going to do that, and potentially the role of an instrument like an EU Renovation Loan to help make that happen. Go ahead.
Can you hear me? Good afternoon, everybody. Thank you very much for giving me a few minutes to speak about what the European Commission is doing and is going to do in this space. It's clear that if the EU is to meet its 55% greenhouse gas emission reduction target by 2030, and moreover its decarbonization target by 2050, improving the energy performance of Europe's building stock needs to be at the heart of our efforts. We have recognized the importance of buildings in this context already with the renovation wave communication, and more recently with our proposals for ambitious revisions of the Energy Performance of Buildings Directive, the Energy Efficiency Directive, and the Renewable Energy Directive, all of which address buildings in one form or other. As regards to financial support for these increased ambitions, in the current multi-annual financial framework, 2021-2027, the EU budget for energy efficiency and building renovations has increased already by around 4 times compared to previous years. And this brings the total amount of financing dedicated to building renovation across these EU programs to around 110 billion euro. Our estimate is that this can trigger more or less double the amount of additional private financing and national budget co-financing. Taken together, this would give us around 35 billion euros per year for building renovation. However, our estimates are that to meet our policy objectives, we need around 275 billion euros per year. And that means that to bridge this gap, we need to massively scale up private investments into building renovation, combined with cost-efficient use of public budgets. And it also means that relying on the traditional grant-based approach for public budget support to building renovations will have to be reconsidered. To mobilize investments at a sufficient scale, we need to make use of financial instruments and innovative finance. And this should be accompanied by an efficient use of public budget for de-risking energy efficiency investments with public guarantees, and on supporting a strong and financially sound project pipeline through technical assistance. Having said that, there are no silver bullets. Multiple actions, financial instruments, and support schemes will be necessary. The building sector and financing needs are so differentiated that a one-size-fits-all solution does not really exist. And that's why I very much welcome today's debate to explore one of the possible instruments in scaling up private financing for building renovation. The Commission, for its part, is proposing stronger regulatory framework across the board for energy performance certificates and better access to data on buildings' energy performance, for certification and qualification of building renovation professionals, for renovation obligations for public sector buildings, for national building renovation plans, and last but not least, with the introduction of minimum energy performance standards in the EPBD recast. Taken together, these provisions provide a clear trajectory and investment predictability to drive the renovation of the EU building stock. With regards to financing specifically, the Commission has made proposals to increase the cost efficiency of public budgets by deploying financial instruments at scale, to facilitate and ensure the uptake of dedicated energy efficiency lending products and innovative financing schemes in the market, and to step up collaboration with financial institutions to finance building renovations. In this regard, it will be key in the ongoing legislative discussions around the EPBD and EED in particular to increase the role that intermediaries such as mortgage and lending providers could play by systematically offering customers information and advice on energy efficiency mortgages and green renovation loans. We are also strengthening the collaboration with financial institutions with the launch in 2023 of a high-level energy efficiency financing coalition based on the work done so far by the Energy Efficiency Financial Institutions Group. I'm very much looking forward to the debate today and to further collaboration on this important topic going forward. Thank you very much.
Thank you very much, Robert, for giving us a few key figures, notably that the amount of money available for building renovations has quadrupled, I think you said, in the current financial framework compared to what it was. But even then, we're still at, I think you said 35 billion a year. We need to be at 275 billion. So note taken too of your point that, well, the instrument that we're discussing specifically today is one of the possible instruments that could help to fill that gap. And a high-level energy efficiency financing coalition, I guess, is a group that could potentially take up that discussion beyond today. Thank you very much for that. Feels like it's high time then that we heard what the EU Renovation Loan concept actually is. And to introduce it, we have Peter Sweatman himself, so our host today, founder and CEO of Climate Strategy and Partners, and a long-standing expert within the energy efficiency financing space. He's the rapporteur for the Energy Efficiency Financing Institutions Group, and also for the G20 task group, the G20 task group lead on energy efficiency financing. He's been doing that for 5 years. And most importantly, I would say for today's event, he is the author of the blueprint for how an EU renovation loan could work. Go ahead, Peter.
Thank you so much, Sonia. It's great to have the opportunity to present our work to all of you. And thank you so much to all of the organizations who have, and individuals who have helped us shape and review and sort of promote this event, and will continue, I hope, to support this instrument over time. Some of you are speaking today, others' names appear in the report itself. All of you who have joined us today will be able to get a recording of this video as well as the report itself. And this presentation that I'm about to make will also be available to you, and it will be sent automatically by the system at the end of this webinar. So my job in the next 20 minutes is just to tell you what's in our report. So Alejandro, if you can go to the next slide. I'll do that. There are 3 main sections. The first describes the current physical state and financial state of buildings in Europe. The second describes what is an EU renovation loan. And the third describes what, aside from finance, is necessary. Next slide. So to set the scene, next slide. Really, most of you, I think, probably understand this, but it's worth repeating. Buildings simply have a long, useful life. Over 80% will still be standing by 2050. They use the lion's share, 40% of energy, and most of that energy is used in the form of heat. So again, to resolve sort of things, of course, energy is used in multiple forms, but that heat right now under the microscope comes mainly from burning fossil fuels. And of course, nothing technically prevents us from renovating. And in fact, 9% of buildings have some sort of renovation, albeit light, every year. 1% of our buildings have some energy performance impacting renovations each year, but only 0.2% factors below what is necessary to meet our climate and energy targets get optimized for energy efficiency. So on the financial side, residential buildings in Europe, of which there are about 100 million, are worth in total over 17 trillion euros. 70% of Europeans live in a home they own, and the total amount of mortgages is around 7 trillion. That leaves 10 trillion, over 10 trillion of home equity. That's the amount of value that there is above the amount of debt, and that's stored in homes. Now, of course, some of those homes, 8% roughly speaking, are publicly owned, and in fact 15% of European households own more than one home. Nevertheless, next slide, that leaves 50 million primary homes with their owner living in them that I feel are opportunities which are currently undertapped or under offered with respect to financing to help them deliver a resilient and a low energy future. Next slide. So in the report, you'll read a section that talks a little bit about consumer attitudes to renovation. This is not primary work that's been done by us, but it's been done by the International Union of Property Owners. Because I think when we talk about the EU Renovation Loan, we're talking about the middle of the distribution curve. So that's most people, as opposed to the edges of the distribution curve, which is, you know, people who can't afford things or people who own enormous portfolios of buildings, let's say. So 44% of people don't renovate because they simply just don't think they need it. But 31% don't renovate because they don't have the funds. This is wanting to renovate. So there seems to me to be a large untapped reserve of people who don't have the funds to renovate, but who would like to renovate. And interestingly, below 10% don't renovate because of either a lack of information or a lack of qualified services, which they don't perceive currently as barriers. Next slide. I also, during this work, wanted to look at the economics of deep renovation. So in a very simple, from a very simple basis, these two slides coming up describe why we need certain components of the EU Renovation Loan, i.e. delivery of a low interest rate. So what this chart, which you may think is complicated, but no, sorry, Alejandro, if you go back one, this chart shows from statistics from BPIE, Buildings Performance Institute Europe. On the dark blue and then the light blue, you can see the cost in euros per meter squared of doing a deep renovation. The light blue, or the highest sort of blue, is the cost of a deep renovation divided by the European region. So south, west and northwest, southeast, northeast and central. And the bars superimposed is the upfront financial benefits of the present value of the energy savings at a 3% discount rate, which is the yellow bar, and then a 5% green premium. So assuming that in that area, as a result of doing the works, the value of the property is more. The 5% is the mid-range of what the JRC discovered, and what EFIG discovered is the classic increase in value that is associated with increased energy performance. So more or less covered over the long term for 30 years, and that explains the maturity of the ERL. But next slide, if you take a 15% discount rate, which is closer to the types of discount rates that people have in their heads, or closer to the discount rates that have been used sometimes to form European policy, you can see what I think explains why a lot of people don't do deep renovations. Those bars, the green bars and the yellow bars, don't reach the level of a medium renovation. So that just simply means, in my mind, unless you have access to low either grants or low cost financing, you won't be able to make economic sense of a renovation. But of course, that does not count the non-energy benefits, the improvement benefits of health, the improvement benefits of reducing CO2. That doesn't account for comfort benefits and any of the other associated. This is a pure economic calculation. Next slide. So what is the EU Renovation Loan and how will it address that? Next slide. So this is a definition used in the report. So we think the EU Renovation Loan is an EU-backed, privately contracted, collateralized loan that provides all homeowners fair and equal access to long-term financing for the deep renovation of their home. The funding is provided on a zero coupon basis, which I'll explain, with a repayment of principal and accrued interest at the EU borrowing costs upon the earlier of transfer sale or its 30-year maturity. Next slide. The components of that are important are the loans will have a single purpose, which is deep renovation. They'll be aligned with the EU taxonomy, significant contribution criteria. The zero coupon structure means that even though there is an interest rate, that interest rate will be established at the level of EU borrowing at the time of the loan, and the interest repayments will just roll up and be paid at the end or upon early retirement. The borrowing amount will be capped at the loan value. That just means you can't borrow more than your home's worth. They will be collateralized by the home, but on a junior lien. That means second to the existing mortgage if there is one. There will be an EU guarantee against any eventual insolvency or collateral insufficiencies. The interest rate level, today the EU could borrow at 2.2% over 30 years, so that it'll be struck if you got an EU ERL today, you'd get it at 2.2%. And these ERLs will be supported directly by a central bank liquidity program. If I look at this structure now from different perspectives, we believe that given that the Europeans need 35 million Europeans need 235 billion annually, which are the figures from the Commission from the EU Renovation Wave communication, the ERL can fill that enormous gap that you heard Robert earlier allude to. Next slide. If there are significant populations that are parts of vulnerable communities which simply don't have access to long-term, low-cost financing solutions, including elderly people who can't take out more mortgages, and those are the people suffering often increased energy prices and have relatively capped or fixed pension income, and for whom therefore a zero coupon structure would be very attractive. And young couples who perhaps have a mortgage, but they don't have savings and they don't have any more headroom, or they can't borrow more under a traditional mortgage structure. So for those two significant homeowner population demographics, the ERL targets these income constrained but yet asset rich individuals by allowing them to borrow more against their saved home equity. Next slide. The interest rate's important, and this chart just describes, so there's something exponential about zero coupons, and that is if you borrow 20,000, for example, today, and in 30 years you need to pay back a compound interest rate of 5%, then the total you need to pay back is moving on 90,000. So the optics of that are very unattractive, even though your home may have been increasing in value much faster than that. The traditional historical home price or asset price increase for homes across Europe has been 5% since records began. So even though your home may be increasing in value faster than the debt, nevertheless, the optics are fairly poor. Clearly, at 2.2%, you'd be paying back in somewhere in the region of 32,000, 33,000 euros in 30 years. Next slide. So this slide just shows the difference between the 235 billion needed and the 25 billion of recovery funds, according to Renewable Renovation Europe campaign, that have been delivered until now through the renovation and recovery plans to buildings renovation. So clearly we need to fill that gap. Next slide. And the provision of an EU guarantee provides, I think, up to 100% more leverage on the public budget. So it's really important to recognize that the components of the EU Renovation Loan, the guarantee, the TLT, the liquidity program provided by the central bank, are existing instruments already used. So the guarantee comes straight from the InvestEU program potentially, and the TLTRO programs already have existed for a long time and just need to be activated to focus on providing liquidity to lenders who deliver ERLs. Next slide. So this is kind of what it would look like. Thousands of retail lenders who are approved under the scheme could provide their clients with renovation loans, and they would be notifying the Commission to take benefit of the guarantees under those, and they would be able to provide those as collateral for lending at the ECB at a privileged rate, providing them a positive funding spread on those activities. Next slide. It's important, I think, to have lenders lenders' interests aligned, which is why if you think about the market that would be created from 3.5 million transactions annually, I estimate that could be for ERLs around 100 billion. The distribution fees payable on 100 billion could be somewhere in the order of €1 billion annually. So this is a significant market, and I think for all the distribution and effort and administration that is required, certainly that distribution fees would be an appropriate part of that mix, and that would align the lenders' incentives to get involved with their clients. Next slide, please. This can also sit alongside existing programs. So it's not that member states are not doing things at the moment, they are. In fact, you have the Eco-PTZ, which is a zero interest rate loan to low-income families in France. You have KfW's promotional support programs for energy efficiency in residential buildings. And in Italy, you have the Eco-Bonus program, all of which could sit healthily alongside the EU Renovation Loan. Next slide. So moving beyond the financing and into what's necessary to as a framework, both a regulatory and a value chain framework, let's take a look at what's necessary to support the ERL. Next slide. So as Robert mentioned, the Fit for 55 package containing the Energy Efficiency Directive, the Energy Performance in Buildings Directive, and potentially, I would argue, the opportunity next year to reopen the Mortgage Credit Directive, you have a series of regulatory and legislative elements that can help member states to ensure that there are high quality training programs offered, that energy data through energy performance certificates are made available to these individuals, that there are certification schemes available in order to ensure an upskilling of the EU renovation workforce, and new certified renovation advisors to work with financial institutions to ensure the quality execution of the ERL renovations. Next slide. How many renovation managers are needed? So this is a quick calculation you can see laid out on the right-hand side of the slide. Basically, I think that if you assume that a renovation project manager can do 10 renovations a year, to meet the 35 million European buildings units that the renovation wave is talking to, we would need around 350,000 accredited project managers. Again, talking of scaling things up, when you take things from a size of 25 to 35 billion to a size of 235 to 275 billion, you are talking about factors of people working in this space. At the moment in Germany, for example, the KfW and the Energy Agency have a program that has around 13,000 of these project managers. We're talking about taking things up by a factor of 10 here. There are 138,000 bank branches in the EU. So if you can imagine all of those bank branches would only have to train 3 project managers if 350 renovation project managers was to work. So when you put it at the scale of the bank branches, I think these challenges become much more achievable. Next slide, please. I'm happy to say that the ITRE committee in the Parliament have noticed the need for an EU renovation loan. The box on the slide seemed to have slipped. It was supposed to be over. So it calls for a special renovation instrument by name, the EU renovation loan. Next slide. And the ERL, I think, fits very neatly into a mortgage portfolio standard framework, which is a regulatory lever already in the recast Energy Performance in Buildings Directive, Article 15.4, which was what Robert referred to in the sense that there are existing tools that are already being negotiated that will promote engagement by financial institutions and mortgage lenders to identify and help finance buildings in their portfolio. But hopefully, as we'll hear later, they do need some extra support in terms of being able to offer the right packages of finance. Next slide. So I think that the ERL, together with the mortgage portfolio standard, certainly will facilitate minimum energy performance standards, which at the end of the day is the upcoming limit by which buildings owners will have to change their attitude with respect of realizing that an inefficient home has a limited shelf life. Next slide. So just closing, there are 6 takeaway conclusions from this report. The first is that we need to be delivering 3.5 million deep renovations every year. That can only be unlocked, I argue, by tapping into the huge amount of home equity savings that there are, 10 trillion of that. We don't need all of that. We need about 10% of that to cover the EU renovation wave. We need a standardized offer that is made by thousands of approved lenders to millions of clients. We can use existing components such as zero coupon design, an EU guarantee, and some liquidity from the European Central Bank. This will align the interests of lenders together with those of the EU institutions and customers, and it'll provide the confidence that member states need to train and engage project managers and to revitalize renovation supply chains. And my last slide says, in order to achieve all of that, I think that, as we heard from Robert, the technical task force can certainly needs to help take this blueprint we're launching today and make it and bring the pieces together and make it real to those mortgage lenders. And I think that can be done in the context and in parallel of the final negotiations that Claude mentioned with respect to the European Performance of Buildings Directive, which in large degree can provide the ERL facilitation framework that I've described. Retail lenders must urgently address their mortgage portfolio climate risks, because we can't have stranded assets and we can't have customers who want to do renovations but can't access the right financing. And finally, we need to make sure there are no financial and prudential regulations that are blocking any of this. And there are some facilitations that could be done to, as I've mentioned, the Mortgage Credit Directive to support this transition. So with that, I thank you for listening. You can sort of put your phone towards the screen and you can download the report. Please follow us on Twitter at ClimateST, and we will be happy. I'll be happy to take your questions later. Thank you.
Thank you very much, Peter. Indeed, a reminder to everyone that you can send in questions. Peter will be with us for the rest of the webinar, of course. So do send those in via the questions tab, and we'll see if we can take a couple of them as we approach 4:30. Thank you very much for that, Peter. It's I think a very clear overview of the concept you've come up with. And I think a few things I take away are the fact that there are 50 million buildings or households that could benefit from this, and that the scale, talked about upscaling, and the scale we could reach is substantial with an instrument like this. I also noted you said only 0.2% of buildings are renovated optimally for net zero a year at the moment, and almost a third of people don't renovate because they don't have the funds to do so. So as you said, clearly indicating there is room for a new instrument to help them do that. And noted too that you said the concept, whilst it is new and innovative, is based on existing tools that already exist, notably the EU guarantee and the European Central Bank providing refinancing for banks that would originate the EU renovation loans. And finally, I think on scaling up, yeah, you mentioned a factor of 10. So we're really talking about something enormous. Also, when it comes to things like jobs, although you said manageable, if you break it down to a more granular level, like looking at what an individual bank branch would actually have to do to make this happen. So let's get some reactions from people in the know on how, I guess, how feasible and exciting this looks. I'd like to welcome Sean Kelly, who joins us from the European Parliament. He's an Irish MEP and a member of the EPP, so the European Parliament's biggest political group. He's been voted MEP of the Year twice, no less, but he joins us today primarily because he's the Shadow Rapporteur on the current revision of the European Energy Performance of Buildings Directive. Trilogues on that starting, with the European Council having adopted a position in late October. And as we heard, the main committee that Sean sits on, the Industry, Energy and Research Committee, has actually already discussed the concept of an EU renovation loan. So looking forward to hearing from you, Sean, I guess a look ahead to the EPBD trilogues, and also how this particular tool is likely, or hopefully is going to be picked up in the new legislation.
Thank you very much, Sonia, and good to be with you today. This is a very important webinar, and congratulations to Climate Strategy for organising it. Without a doubt, the renovation of the EU's building stock is a key Green Deal priority, but since this designation, the landscape in Europe has changed. This is a problem at the minute. The pandemic has left significant scars across Europe, not just in social and health terms, but also upon the economy, supply chains, and trade routes. We suffered under the cloud for 2 years, and as governments borrowed to keep the economy afloat, we must be aware how this has affected individual purchasing power and the strength of national purses. Even with the consequential impact of the pandemic, the world's gaze has shifted to a new crisis in the East. Putin has waged a callous war against a peaceful neighbour, willfully ignoring the unnecessary and tragic loss of life. Yet his actions have fundamentally changed the trajectory of the energy transition and caused a crisis in security of our energy supply. However, what we must try and emphasise is, in reacting to the crisis, we must not trade one dependency for another, nor should the immediate actions of the energy crisis be to the detriment of the future needs of our energy system. Europe has changed, the world has changed, and we must be prepared to change with it. Bold action must be taken to protect citizens from the worsening energy price hikes. That has to be done, especially this winter and next winter in particular. The market should be for the benefit of society and not siphon the life out of it. To reduce dependency on fossil fuels, particularly gas, it is clear that further action is needed to reduce buildings' energy consumption. A massive scale up in renewable energy and power generation, industry, buildings and transport will accelerate our phasing out of Russian fossil fuels. It will also, over time, lower electricity prices and reduce fossil fuel imports. This is an inflection point for EU energy policy. Reducing residential energy consumption will greatly reduce the need to increase the EU's generation capacity, especially for peak hours. Less pressure at peak times allows better grid balancing and extenuates the effectiveness of demand-side flexibility measures. The residential sector alone accounts for 40% of EU gas demand, mainly for heating and cooling. Reducing residential energy consumption would greatly reduce the need to increase the EU's energy generation capacity, especially for peak hours. However, at present, there is a funding gap of 214 billion a year for green financing for residential buildings, which will require a greater input from bank loans. I agree that bank lending is an appropriate channel to respond to the financing of renovations. They are elastic and decentralized via the extensive network of commercial retail banks, which Peter spoke about a few moments ago. Banks already play a key role in funding house purchase transactions. It is therefore natural that banks should also further facilitate the financing of renovating those same houses. However, households and businesses lack incentives to take up loans for renovation purposes and face liquidity constraints. As for the state of play in DPP discussions, which you asked for, the first thing I can say is that we are still in the middle of intense negotiations at political and technical level. The Council has reached a general approach described as a fragile compromise. However, in my view, this approach is not strong enough, and at this point it is clear that big gaps exist between the two co-legislators, even though, of course, Parliament's position isn't finalised yet and is indeed complicated at this point in time. Internally, within the Parliament, as I said, there's a significant division. This is best illustrated by the fact that the Transport Committee voted against its own opinion on Article 12 of the EPBD on sustainable mobility, where it is joint competences. The EPBD itself has become highly political, not welcome, but true. Yet finding a balance between the need to revamp the built environment and not impose undue financial burden on households and businesses will be extremely difficult. It may be difficult, but at the same time, in my view, it is necessary. This is not just a carrot and a stick matter, but also a capacity matter. However, the EPBD under Article 15 extends the toolbox for member states in relation to financial incentives and market barriers, including energy efficiency loans and mortgages for building renovations, and by introducing the notion of a mortgage portfolio standard. Thus far, we have had only preliminary discussions on Article 15. However, I've been encouraged by the exchange of views we've had so far, and I believe that EP will support strong provisions in this article, and certainly I'm working towards that. I would say we should ensure it does not become too bloated and sends a strong signal to the financial sector with provisions to support staged deep as well as deep renovations. There needs to be much stronger links between the financial and the renovation sectors. The EPBD can play a big part in this. Firstly, by ensuring banks have the appropriate access to data so that they can access or assess their risks. Secondly, there must be serious consideration given to making mortgage portfolio standards for banks mandatory. In my view, the Commission should be empowered to specify the regulatory pathway for mortgage portfolio standards to provide further clarity around the functioning of this innovative mechanism and ensure a level playing field. However, an EU-wide renovation guarantee fund would enable credit institutions to reduce their risk exposure on green mortgages portfolios and would mitigate additional requirements for banks. I have tabled amendments to the EPBD to specify this and have engaged with officials in the Commission to further investigate this possibility. Unfortunately, at this point, it is too early for me to share progress as we're still working on the initiative and it has only briefly been discussed in negotiations. There are several innovative financial mechanisms and loans that could be deployed to incentivize borrowing. Experts will go into detail on these. Already Peter and Claude, Robert have mentioned some of them, but the provision of affordable long-term funding must be at the core. This is going to be a key point for us, and I look forward to further discussions, and hopefully we will get it finalised and voted on in the ITRA committee this month with a view to finalising it probably in January of the new year. So with that, I thank you very much for your allowing me to speak. And then, of course, as I say, once we have the meeting at the full Parliament, if they vote in favour of our report, which I hope they will, then the trilogues would start in January. So that will be when we will be really getting down to detail. And as I mentioned initially, we would regard the proposals coming from the Council as somewhat weak. There are those within the European Parliament who want to have our report maybe even weaker. So it's delicate at the moment. We have to see what we can do, and obviously we must build a majority, otherwise then we'll have nothing. But I'm still confident because all the evidence is there, as has been pointed out, that if we do not have a good EPPD, then we are not going to meet our targets for 2030, not in mind 2050. Thank you very much, Sonia.
Thank you very much for that, Sean, for giving us an update on where things stand in the Parliament and indeed the complications of getting a position agreed there, never mind with the Council once the trilogues start. And I think thank you also for bringing in the wider context. Indeed, we've moved from one crisis to another. And that has meant, I suppose, that the urgency certainly of doing something on energy efficiency in buildings is greater than ever. And as you've pointed out, there are a number of things. So there's a lot that the EPBD could do to help with that, from introducing mortgage portfolio standards to creating this facilitating framework that Peter talked about for an EU renovation loan, and on a very practical level, things like ensuring appropriate access to data. Thank you very much for that. We turn then from the perspective of the EU policymaker to the perspective of a financial institution. So I'd like to welcome Dr. Tobias Horn, Head of Portfolio Management and Strategy at the Deutsche Bank Group. And we heard earlier in Peter's presentation that this is a concept that should make sense from a lender's perspective too. There is a business case for it. Increasingly, financial institutions too are looking to align with net zero, and that means for them too looking, I imagine, looking for tools to green their existing mortgage portfolios, amongst other things. So Tobias, looking forward to hearing from you, I guess, how your organization views the energy efficiency building renovation market, and how a concept like an EU Renovation Loan could help you as you move forward as a business.
Hi, thanks for having me today and giving some insights, and good afternoon to everyone. So when we're looking forward to 2050, we already know that 80% of the buildings will be built as of today, which means renovation is a key factor in order to reach the targets for the real estate sector. Looking a little bit deeper, there's a recent study from energy consultants in Germany that replied that 82% are not that for 82% promotion programs are not sufficient. What's the reason about that? It's all about client behavior. First, the willingness of the clients to do the renovation, and secondly, of course, the financial capacity. Regarding the first point, that's really a challenge to policymakers and lenders. And I slightly have to say, regarding that was shown that when I look to the German market, only 25% of the households are financed by a loan. Hence, the lender impact on the market is narrow. And we have to think about the 75%, how we can they motivate and get the willingness there to renovate their properties. Maybe by concepts like getting it capital also for their grandchildren, as it was pointed out by Peter, that also the older householders should be engaged to have renovations for their property. Because especially for this group, the second part regarding capability is on the one hand side more easier to reach, since normally they have the financial income and savings in order to do the renovation. But it's, as we have seen by Peter's statistic, highly unlikely, because they are often thinking they don't need to do it due to their stage in the life cycle. So it's especially there the case that they are feeling too old for substantial renovation, as well as they are trying to save costs and wealth also for the next generation. But when we are looking on our own portfolio, where we have a lot of lenders, mid-age, between 30 and 50, building up their own family, building up their own home and wealth, we see that roughly 25% wouldn't have the financial capacity to have an additional renovation funded by a loan in order to improve energy efficiency for their building. This very well fits to the 31% we have seen before, and therefore it's really a challenge how we can get people who are in the life circle and being ready to do a renovation in the financial capacity to do it. So for mortgage lenders, we need some attractive ways to offer home loans to save energies in the coming years, because they have to do the renovation for the existing buildings. And a tool like the European Renovation Loan can open the market to a wider range of families, for example, and allows them to invest in renovation of heating and photovoltaic, etc., which will reduce, of course, their bills and improve their credit standings at the time of inflation and rising interest rate, as we can currently observe. Thanks.
Okay, thank you very much for that, an insight into the German market a little bit, and I suppose how you approach this issue and the need and the ways in which you might reach those people whose homes aren't currently financed by a loan and enable renovations there nonetheless. We've seen questions coming in. I think most of our speakers, I'm not sure all of them, but most of them are still around. So whilst we're going to go to a panel discussion now, and we're going to have 3 panelists for that. Certainly Peter is still around as well, and will be on hand to answer questions. And there will be, I think, some of other speakers perhaps too, if you have questions to them. So for our panel, indeed, we've got Lukasz Krebel, Guillaume Joly, and Stan Jourdan. Welcome to all of you. And I'll give you each a slightly longer but short introduction as I hand you the floor. So the idea was to use this last half an hour to get some additional perspectives in and to discuss the concept in a little more detail, and also to take your questions, as I said. So first of all, let's start with Lukasz. So Lukasz Krebel, who joins us from the New Economics Foundation, where he's a senior economist. So he works on monetary and fiscal policy, and as part of that is also looking at greening central banks, which seems relevant in the light of today's discussion. So Lukasz, you're coming at this from a macroeconomics perspective. And I saw there was one question which asked about whether there is any moral hazard in this proposal potentially for the I guess, finance industry. Maybe you could kick off by telling us whether what you've heard so far, and does it sound like a great idea? Should we be worried? Are there obvious financial risks, traps, things in there that could mean it ends up blowing up in our faces, or should we embrace it with open arms? You're still muted.
Right, should work now. Thanks, Sonia, and thanks, Peter, for hosting this event. Yeah, so in terms of like any hidden issues potentially with this proposal, so I wouldn't be that concerned about that, because I think it's a very well thought out proposal that comes with safeguards and some ideas to verify it, like the mortgage portfolio standards, and the report covers a lot of ground about how whether the lending goes into the right direction can be actually verified and validated. So I think that the risks there, that there are maybe some edge cases, and I mean, we cannot prevent like anything bad happen, but like overall, I think it's a pretty robust proposal. And also, I mean, we need to consider what is the risk of not doing something of like this program. What is the risk of not doing like a massive renovation wave in the EU, and what the impact will have on climate, as well as on household bills, or like not reducing our dependence on Russian gas or generally on fossil fuels. So I think the risks are very much on the side of not doing program of this type to deliver this retrofitting wave. And I think this proposal it involves a lot of as Peter outlined, existing instruments and so on that just need to be put together, and then the report outlines quite nicely how this can be done. So I think there can be a strong governance framework set up to ensure that and already small risk can be like minimized. So I see it as a strong proposal.
And is there anything you'd say that should be built in from the start to avoid or to minimize the risks that are there? I know you said that the greatest risk is not doing anything, but is there anything that should be, I guess, that we haven't heard yet today that you would add and say, we must make sure to build that into the design from the start?
Yeah, so I mean, I think that the one element that needs to be strong is like, so we have the element of the European Central Bank providing liquidity to commercial banks to then lend on creators loans and so on. So we know, obviously, with the banking system, the private banks, they sometimes tend to misuse their money, engage in, either greenwashing activities or just misusing the funds completely. So I think what we need there is just, a strong verification framework that the ECB needs to keep their eyes on the game, on what the banks are doing, and ensure they can spot check and regularly control that the banks are actually using the money in the way they should be doing. So I think that's very important to bring it up front.
Okay, yeah, that's clear. Okay, let's go to Guillaume. Guillaume Joly, as I said, who's a Sustainable Housing Officer at BEUC, so the European Consumer Organization, so brings to this discussion a consumer perspective. Guillaume spent many years working in local authorities in France, so is also specializing in an inclusive energy transition within the residential sector, also worked at C40 before joining BEUC. So there's been a couple of questions that have come in which pertain, I imagine, directly to what you're going to say. One asking whether there was any research done with homeowners in terms of how appealing this actually looks to them. I guess that's something Peter can pick up on later. But it would be good to hear from you. It sounds, I'm not going to say it sounds too good to be true, but it sounds pretty good for consumers. What's your take on it?
Yes, thanks for having me, and hello everyone. Indeed, it sounds interesting because as a consumer organization, BEUC, we are supportive of more affordable and more accessible financial instruments and offers for the energy retrofit of homes. So the EU RL sounds like it might be a good instrument. And today, we still see some issues with financing. To illustrate, and you were mentioning the potential research, what we observed with our members, so consumer organization across Europe, is that in most countries where green mortgages are provided, they are more expensive than regular mortgages. So there are a gap to be filled here regarding existing instruments. I wanted to also say that BEUC supports the evolution of the European Central Bank monetary policy towards green TLTROs. We think it's important to keep interest rates lower than average for the economic sectors we want to foster, because it's also a good way to make it cheaper for consumers to renovate their homes. Also, the point on leaning on the value of the housing stock itself as a leverage to engage more households also has a good potential if channeled properly. But to say here that current equity loans are not up to the task yet, because they don't necessarily address accessibility to the loan for the elderly as a priority, as we can see in France with the existing equity loan launched a few months ago. That's why we need to ensure that the financial tools fill these gaps to meet consumers' needs. This is where the EU Renovation Loan can play a role. We do agree on this, by helping to pave the way to private financing via banks. However, it cannot be a standalone and needs to be combined with other enabling tools to ensure it is inclusive of low-income and elderly households. A European framework for guarantee funds is needed to address the complicated situation that will emerge. Property exposed to natural disasters as flooding, for example, who would have to pay and what? Or inheritances grinded to a halt due to diverging thinking of heirs about selling the property. Should we sell? Should we not? At which conditions? Consumers need to see the possible liabilities are anticipated to avoid leaving them stranded in impossible situations. Also, consumers need clarity regarding the resulting compiled cost of the loans. How much will it cost me in the end? How much will it cost me to repay ahead part of the interest, for example? Are the insurance costs factored in? How is the green value of a property expected to evolve compared to local conditions? A capital city and deprived rural areas don't have the same potential, for example, regarding the green value. And there is here a certain gray zone on the exact scope of cost covered with the EU Renovation Loan. In any case, for the benefit of consumers, creditworthiness assessments are vital to ensure that loans meet consumers' needs and capacities. These assessments shall factor in subsidies in the case of low-income households. And in conclusion, for the EU Renovation Loan to be the tool that fills the gaps, a few more consumer protection need to be granted for it to work. But we are welcoming it as a good potential.
Okay, thank you for that. Do you want to jump in very quickly, Peter, to say whether you did any research with homeowners as part of preparing this?
Thank you, Sonia. I can jump back in. I was responding to people's questions in writing, actually. I don't know if people can see that. There are so many systems around. I've been sort of typing in answers to people who've asked questions. But to the question that was raised on additional research. So we just did a review of all secondary research. So when you write a report like this, it's taken us about a year. You do as much as you can. I forget, there's probably something like 140 sources of literature that we have kind of read and sort of like gone through to pull out the most relevant facts in order to support this case. In so doing, we did read a lot around what the existing products were, and we review them in case studies in the report. So the French case studies, the German case studies, the Italian case studies. We also looked at attitude surveys and the review that was done, I think, in the UK of how people reaching the, or elderly people prefer to stay on living in their homes much more so now than ever before, and for that they need accessibility renovations to make sure that that is possible. And I feel that an ERL could consider accessibility as potentially a key driver for also energy performance within those cases. So there's definitely a body of research that we've looked at that talks to the point on consumer attitudes. I can't say that we, in the writing of this report, did primary research. We did not do surveys ourselves, but the purpose of launching this blueprint now today is to encourage all of you to do exactly that. There was another question that said, have you tested this out with banks? Well, the answer is absolutely. We've sent the proposal. This draft report has been circulated to a number of financial institutions for their comments. And, you know, we encourage you to do that. So if you know of a bank that you think could be interested in helping be a part of launching this, send them the report. It'll come to you via email for everybody who attends this, and send it to them and tell them to get in touch, and we'll certainly take it from there.
Okay, thank you. Let's bring in Stan Jourdan then as our last panelist. So Stan is here as Executive Director of Positive Money Europe, which he joined 7 years ago now, initially as their international coordinator. And he's been heading it up now after 2 years spent on quantitative easing for people, special campaign they ran, and international movement for monetary reform. And Stan, so you're also an expert on financial policy and making sure that it delivers for people. How do you look at the concept Peter has presented to us today?
Yes, thank you, Sonia, and good afternoon, everyone. It's a good pleasure to be taking part in this webinar. You know, I think from our perspective at Positive Money Europe, and I have to say we also are running a campaign called the ENER Renovation Campaign that exactly talks about how to finance renovation. So I think, you know, this type of proposal is exactly the type of products that we have been thinking that banks should develop since we started our journey into thinking about this issue. So we are completely supporting this proposal. It may not be the only proposal, as Guillaume said. Other types of loans could be developed. I think a particular issue when I've been speaking to people about this, and in my family, for example, about this product, I think what people really feel strongly about is the fact that you would only repay this loan after 30 years. Sounds a bit scary that you kind kicking the can down the road, and so perhaps early repayments should be facilitated to ensure people are not just forgetting about this loan and passing the problem to their children or something like that, you know. But apart from that, I think this is typically the type of thinking we need to make. As many speakers have said already, we think the banking sector is not up to their job right now in terms of funding the renovation wave. But for us, the critical thing would be the cost. The cost of these loans is critical, and not only the cost, but also the fact that the cost must be stable in the sense that people can foresee what will be the cost of these loans tomorrow. And this is why I think right now what the European Central Bank is doing by raising interest rate is doing more harm than good in that respect, because what they're doing is they're raising the cost of all capital investments, including green investment, including the investment that we need today to tackle the inflationary crisis that is caused by fossil fuel energy that we import from abroad. And as many speakers have said, and as the ECB has recognized themselves, obviously more energy efficiency, more renewables energy that we produce domestically, that would reduce the pressure from inflationary sources. So it's critical that energy efficiency is a critical factor for the success of the European Central Bank's monetary strategy. I would like to insist on that. This idea that the European Central Bank could offer low interest rates is not a pipe dream. I think it's a win-win deal for the banking sector, for consumers, for the planet, also for the ECB, also for monetary policy, for price stability, because currently energy efficiency would be the best response to lower inflation. So that said, I think we've been campaigning actually on this idea for 2 years now, and I'm super pleased that Peter's team has embraced and make this idea be their own. I think that's a very great development for us. And I would emphasize again, this idea has been considered at the ECB. Christine Lagarde is in favor, alongside with a few chief economists of banks. A few months ago, we did the letter to Christine Lagarde. She responded a few weeks later saying she agrees. So what needs to happen next? I think that's a quick question. That from back in the days, I mean, a year ago when the ECB looked at this, they said, oh, we cannot do it. One reason was the lack of data. They could not know. They could not know if banks are doing renovation loans or mortgages, or there's no classification in place. The good news is this is changing. The taxonomy is now adopted. Starting 2024, banks will start reporting on their taxonomy alignment, and renovation loans are clearly identified in the taxonomy. So this is not an excuse anymore for inaction. The second argument the ECB came up with is what I said before, like I think a year and a half ago, maybe this idea was a bit far-fetched. Maybe it was maybe a step too far in the ECB's thinking about greening their policy. And the argument was it's not directly enough connected to our primary mandate. But as I said before, this has changed now. The energy crisis is here, and this is a great reason why the ECB should change tune and reconsider this idea moving forward. But of course, what needs to happen before the ECB can really implement this is that we need to see banks developing these products. We need to see the European Parliament and the Council and the Commission working together on the mortgage portfolio standard, because this is what will bring all the actors to integrate energy efficiency into their model, into their business strategies in a way. And once the entire sector starts moving, it will make sense for the ECB to say, okay, we need to make sure that this goes somewhere and this is going to scale up. So yeah. I think that would be my few points at this stage.
And do you see appetite amongst, because ultimately this depends on the EU signing up to it, the ECB, I mean, European Commission, do you see appetite? You and the others are free to jump into for this, to take this forward?
I think from the central bank community side now, there's a bit of a pause, I would say, in the thinking about greening the policy, and I think that's very sad that they are pausing a bit their reflections, at least publicly. That's what we feel. My feeling is that this will come back very soon enough, because what we're going to see in the next few months is that we're going to see municipalities stopping their renovation projects because they have to face super expensive energy bills and they don't have the resources to pay for renovation. We're going to see the cost of capital basically increasing, including for renovation project and other energy efficiency project. And we're going to start, I think, we're going to really start seeing the side effect of the ECB strategy. And I'm not saying they should not raise rate. I'm just saying, they should keep rate lower for certain investments, for certain niche investments, actually, because they will not represent a vast majority of the bank lending, but a significant share. So I think the tide will change in a way in the next few months. And it's up to us, civil society actors, experts, and policymakers to keep our heads tight to what needs to happen, and don't lose focus about the short-term concerns about raising interest rate and so on. We need to keep our head looking at the long-term strategy that we have.
Yeah. Lukasz, do you want to come in on that? What kind of appetite do you see? And maybe if we think about the broader financial framework too, Peter mentioned the mortgage credit directive. Are there other opportunities to move other pegs, I suppose, this could be hung on in the months and years ahead to take things forward in a very concrete sense?
Yeah, so I think, as Stan already indicated, I think in the next few months we will start seeing some shift, especially as the ECB's policy of higher interest rates is pushing Europe further towards recession. And just today, the Bank of England both announced UK is in the recession already, at the same time as increasing interest rates further, which will only make the economic situation worse. So once we are in a recession environment, actually the case for central banks to intervene with expansionary policies, so the policy of providing more lending, becomes stronger, even if they're orthodox mindset. So that creates more opening for them to act in that way, because this prevailing orthodoxy about higher interest rates and targeting inflation purely in that way has proven a bit of an obstacle of getting the central banks acting now. But I think we will be getting there in the next few months, given this policy will not really deliver the results that they expect. So I think that will be one thing that will change. In terms of the other EU policy development, so I think what the central banks typically insist on, they are not the policy leaders in that space. They have their mandate on price stability, financial stability, but they need the government, or in the EU case, the EU Commission, the European Council, to move first. But I mean, that's already happening. Like Peter also outlined, there's various initiatives that the European Commission is developing about mortgage portfolio standards and so on, as you also mentioned, Sonia. So I think as those initiatives develop further, the central bank has that policy lead that they expect from other policymakers. So now at that point they are no longer policy leaders, that they are just there to support, which is also part of their secondary mandate. So I think again that is moving in the direction that they will feel empowered to do so before too long.
Okay, thank you. We're gonna have to wrap up soon, but a final question to Guillaume. There were quite a few questions that came in about targeting this instrument, and people asking how can we ensure it gets to the people who can best use it? Couldn't it also work for SMEs? Couldn't it also work for municipalities? What about landlords? Lots of questions in that vein, and I guess on the back of that, I'd be curious to hear your thoughts on targeting it. And also what kind of protection ultimately would be needed to make sure consumers do really benefit at the end of the day?
Well, thanks. Very, very good questions. Here I would echo what was said on the facilitation framework. For people to be reached out, I think it's not only a matter of communicating from banks, it's also implementing and rolling out one-stop shops. So places where people can go and benefit from impartial advice and support, be it at the financial level, but also technical and administrative. So that's where households most in need would get not only the information, but also would have the support they need to make them tick into the solution. Regarding landlords, here it's also a question regarding the facilitation of the trade-offs between public support and consequences on the market. Any support to landlord, it should be open, I guess, to them, would have to be compensated with a cap on rent and a rule for tenants to not be paying the bill of the energy retrofit. You need to find the balance here.
Okay, thank you. And that's probably all we're going to have time for. There's been lots of questions. I know Peter's done a fantastic job of answering many of those in writing. So thank you for that, Peter. Please carry on. We've got another, 7 minutes for you to write. A big thank you to our panelists, and I would say to those joining us today, do feel free to follow up with them to continue the conversation after this webinar. I'm sure they would be happy to engage further with you. So a thank you to all of you. And then I would like to invite Adrian Joyce to join us to give us some takeaways from his perspective. Adrian, I hope, again, a familiar face to many of you, Director of Joyce, the European Alliance of Companies for Energy Efficiency in Buildings, and also the person who heads up the Renovate Europe campaign. Are you excited, Adrian? You're still muted, indeed.
Thank you, Sonia. Yes, indeed, very excited, not only to be here today at the launch of the EORL, but also about all that's happening out in the world. I wanted to start by saying, haven't we heard a great deal of very good news in this session, where Peter and his team have worked out in detail a really good proposal that can fill one part of the financing gap that will allow us to achieve the ambitions of the renovation wave of those 35 million building units by 2030. But in reflecting on what to say, I recall that back in 2020, the Renovate Europe campaign had called for the creation of a European Renovation Fund. And at that time, our call was supported by 125 companies and associations from across a broad spectrum of actors. And, you know, thinking about the concept behind the European Renovation Loan, I realized that that fund exists, but it exists in a virtual way. It exists as the equity tied up in the homes of those who are homeowners with no mortgage left. And the way I now view the European Renovation Loan proposal is it's the key to unlock that fund. And that fund, as Peter pointed out, reaches 10 trillion euro. So enough to do the job of providing 250 billion per year over the next 20 or 30 years. So I found that the discussion showed all speakers supportive of the concept. You all demonstrated the how and the why, and indeed across affected sectors, we see support for this concept. I suppose my question will it be taken up by the instances that need to implement it? And I suppose time will tell. And there was an interesting discussion in the panel debate around owners and how you motivate owners. And I found it interesting on the landlord-tenant split because, and now to kind of mix a few things, the Buildings Directive has a proposal to introduce minimum energy performance standards. And landlords seem reluctant to support this concept. But it struck me that this European Renovation Loan concept gives the means to landlords at no short-term cost to themselves to actually comply with minimum energy performance standards. So the European Renovation Loan comes along and gives the means for a very important tool, the minimum energy performance standards, to be implemented moving forward. Another aspect of the discussion that struck me was Peter's words, where he talked about this instrument is capable of turning hidden equity in homes into real products, into real jobs, into real economic activity in the market. And maybe that's a better way to think about the renovation loan for certain stakeholders that must be supportive of the concept, that this is the enabling tool that turns an abstract economic concept of equity into concrete products and boots on the ground. So overall, I've been very encouraged to hear the broad-based support for this concept. I really hope it'll be put in place quickly. In the short term, I took encouragement from Sean Kelly, who hinted that yes, the European Renovation Loan concept could get a mention in the directive alongside the mortgage portfolio standards in Article 15. And truly, I hope that that comes to pass. I suppose the last thought that I've jotted down here was what Stan said about the power of capturing the energy efficiency in buildings through this instrument. But my thought there was energy efficiency must lead to a reduction in actual energy consumption, and in that way it becomes a fuel that we produce here in Europe. So that energy security aspect that the ERL could release also struck me during the exchanges on this call. So Sonia, I think I will wrap up there. Peter and your team, really great job, very well organized session, great work. I just hope it lands where we all hope it lands. So back to you, Peter, for I think a few wrap up words.
Thanks, Adrian. I think at this point, I want us to say most importantly, thank you to Sonia. Sonia, you've done an amazing job moderating these sessions, and your support of you and your team is greatly appreciated. And to you, Adrian, for doing such a very good job of summarizing a fantastically content-rich event. To all of you who've written questions, I've actually now answered all of them bar one. So that was about 13 questions. So thanks for that. All of you will get, as I said before, an email after this webinar, which has the recording and all of the handouts and the report itself attached. You can download the report on the QR code there as well. It'll be put on our website. We encourage you, and all of us here present will be answering questions via social media and email. This is a new concept. It's a blueprint for action. I think a number of you have sort of asked me, is it better or worse than other funding schemes? Is it, I don't think that funding schemes actually do have to compete. They just all have to be there. In the end, the consumer will choose what's best for him or her, the local authority for them, and we have, as you've seen, the challenge is so massive. We've got to do 3.5 million actions at a deeper rate than we currently do, considerably less. And so it's really all hands on deck. So I think the energy efficiency community and the buildings renovation community would do itself a favor, not sort of competing one idea against another. We just need to make sure that all the potential renovators and all the potential renovations are both done, funded efficiently, and done to the deep standards that are required by our energy efficiency trajectory, and frankly, to make us less dependent on gas. So with those closing words, again, thank you to panelists, thank you to speakers, thank you to reviewers, thank you to Sonia, thank you to my team for all of the hard work you've put in. And I say, just watch the space. I really hope that this will launch a series of activities and that you'll all be a part of it. Thanks very much. Bye-bye.